It's a pleasure to be here and a pleasure to be able to share some information with everyone here who's attending the webinar and the Zoom meeting. I know I'd rather be there in person and see you guys and interact with you guys. That's usually the way I prefer, but given the circumstances, this is how we're going to do it. And today, like usual, I have a PowerPoint. Just give me 1 second. Let me share my PowerPoint presentation with you. Um, Bear with me for a second. Here is the PowerPoint presentation. You guys can see the PowerPoint, right?
Yes, we can.
Great, great. So today I am going to, give you 1 second. I am going to talk about, the economic and market update, and based on the current event, based on the coronavirus impact that we are currently encountering right now. As you know, the COVID-19 and the coronavirus pandemic is really doing a lot of making a lot of a big difference on our daily life as well as the economy and the housing market. We are all sheltering in place and staying at home right now for weeks already. I think it started in mid-March. For someone in Bay Area, it started, I think, on March 16th, and for other parts of the states, we started right around the 19th or 20th or so. So it makes a lot of changes. It's uncharted territory for all of us. And I think it's worthwhile to take a look at, how it affects our daily life, also how it affects the economy and the housing market. Now, I always emphasize, the understanding the housing market is understanding the economy is very, very important, because that is the big picture. We need to understand, what's going on with the big picture, and then how it, in fact, influence the housing market and the real estate industry. So I'm going to go into, first the impact on the economy. I'll tell you that right now, I know some people may still think that we're not in a recession, but a lot of economists already believe that we are already in a recession in March and going into the second quarter from April to June, and then maybe even in the third quarter. So nothing is recession proof. So I'm going to go into the economy and tell you what we have observed so far, some of the evidence that we are already in a recession, and then I'm going to go into the market. I'm going to talk about the housing market a little bit. Some of you might have already seen some data already on a weekly basis. Now, we release our monthly statistics just yesterday, but that may not be the most timely. So we do have some weekly data to show as well, to give you some sense of where the market is right now and where we might be heading. And many of you also might have received some survey data or surveys from us. We have been sending out a survey on a weekly basis to kind of gauge the sense of where the market is based on the buyers and sellers perspective, as well as the realtors perspective. So I'll share some of those results as well. And then for the last 15-20 minutes, I'm going to go into an outlook, to talk about where the market is. I'll tell you up front right now that because the market has been there have been a lot of uncertain factors and certain variables for both the economy and the market. We don't have an exact forecast, but I'll give you my insight. I'll tell you where we think the market is going in the second half of the year, and how long this is going to last based on the all the information that we have now. So let's take a look. Let's take a look at some of the slides that I'm going to show you, and let's go into the economy first. So as I mentioned, the economy is having a tough time right now because of the shutdown, because of the shelter in place and the stay-at-home orders. A lot of daily activities, a lot of economic activities have been pretty much shut down. Now, many of you who live in the Western Gabriel Valley already know that many of the restaurants have been closed, and we may be taking some takeouts and maybe picking up some food, and a lot of people actually have been cooking at home. And so the restaurant business have been affected significantly. We look at data from OpenTable.com and from JP Morgan. We saw that this is a slide that shows you how many people actually make reservations with restaurants. Now, in February, end of February, mid of February or so, we were still the number of people making reservations was still tracking quite consistent with the previous year. New York City, San Francisco, U.S. as a total, which is the blue line right here, still shows that it was somewhat consistent with last year until around the beginning of March. We started seeing a little bit of a slowdown, and it continued to drop to the very bottom. So we know that it affects a lot of the dining industry, but it's not only just the dining industry. The entertainment industry also got affected because of the coronavirus pandemic situation. We all should be practicing social distancing, and people are also concerned about gathering in crowded places, with people gathering in let's say more than 5 people, more than 10 people. People are concerned. So and movie theaters are a place where we see a lot of people. So as far as movies being shown in theaters, it was still tracking fine at the beginning of the year, despite the fact that we may not have as many great movies at the beginning of the year as last year. We're still tracking fine. The number still looks decent. Now this orange line right here is the estimate, and the blue line is the average between 2017 and 2019. We were slightly below last year in the end of February, but it started slowing down really significantly. And based on the forecast here, or some numbers here, the box office basically went down to 0 as far as the box office receipts are concerned. Many people, some of you might have already seen some of the movies being streamed online through Netflix, through Hulu, through some other means. So those movies have been being put online instead of being in movie theaters. Now it's not just movie theaters, also because the reason why we're doing Zoom is because we're not traveling as much. For me, traveling to Western Gabriel Valley is not very far, but let's say if I were to travel to up north, I wouldn't be doing that anymore because of the shutdown. So it affects not just me, but a lot of businesses as well as leisure travels. Look at the U.S. hotel occupancy rate. That has gone down pretty significantly since the end of February. We actually had it going down as far as the occupancy rate. Typically, it should be right around 70% or so. It's dropped down by the 11th week of the year, which is towards the end of March, has already dropped down to 50%. I have no doubt that that number actually has dropped down even further. Of course, that hotel occupancy also are quite related to other traveling means such as the commercial flights. If you look at daily commercial flights, this is a global number. That number actually has gone down quite significantly as well. If you look at the 2020 number, which is the red line here, typically we should have, on a daily basis, we should have about 200,000 flights at the beginning of March. That number was actually trending up above some of the other years until maybe about the 10th, 11th or so. Now on March 10th is when the WHO announced that COVID-19 outbreak as a pandemic. That's when a lot of travel actually stopped, and we stopped traveling. And C.A.R. is actually not going to. We probably will be hold off on traveling until somewhere around September or maybe past September or so. So that actually has gone down quite significantly as far as the number of flights are concerned. I have a friend who works for Delta, and I think she mentioned to me that many of the flights got canceled. Maybe about 90% of the flights got grounded. No one is really flying right now. Not a lot of people are flying right now. So the number of flights have gone down significantly. And I'm sure many of you are sport fans, right? Sports fans, you know that the NBA season has been canceled. I think in the early March, we saw that some players got tested positive for the coronavirus, and the whole season got canceled. When it is going to come back, we don't know. I mean, I personally am a basketball fan, so I watch basketballs. But I know that we this is not the time to gather together in a stadium or in a Staples Center to watch basketball right now. So I have been watching some old games before, some classic games before. But as far as the season is concerned, it probably won't come back until, if it comes back at all, it will probably won't come back until somewhere in August or so. So this has been affecting a lot of our daily lives. Something that actually has increased in traffic rather than decreased is the grocery delivery service. I know we from some of us, go to grocery shopping, still go to grocery shopping and go to Ralph's and go to Costco to pick up some stuff. But many of us actually ordered groceries to be delivered. As far as the traffic of the grocery delivery traffic is concerned, it actually has gone up quite significantly based on some website traffic statistics. It has gone up by 150%. Delivery for restaurants, though, didn't really move that much. In fact, it might have actually dipped down a little bit. When we do nowadays, when we go do takeouts, sometimes we just go pick it up, or we might have it delivered, but it doesn't seem to have increased that much as far as at least through mid of May or end of May. That number might have actually gone up a little bit. But so you can tell, based on all those numbers, that the economic activities and our daily lives and in the economy has gone down significantly. Now, we have a report that just got released a couple days ago by the Census Bureau, and it released numbers on retail sales. Retail sales is very important for us to understand because it really reflects how consumers are spending and how we're actually doing as far as the economy is concerned, whether it is growing or not. If you look at this category, the slide here, it shows you sales of different categories, the percent change from February to March. And you can see, all the retail stuff, the clothing and accessories, for example, dropped 50.5%. Now, that's partly because we're not able to go to mall, go to other places to shop. I mean, we can still shop online, but the clothing and accessories actually dropped significantly. Now, furniture, home furnishing, food service and drinking places, those are restaurants that we visit, dropped 26% or so. Electronic and appliances store like Best Buy, they all dropped. Now they have like curbside pickup and stuff like that, but all of those dropped. Now the food and beverage, which is grocery stores, supermarket, have gone up a little bit. But overall, if you take a look at the statistics, you realize that as far as the total resales are concerned, it actually has gone down by close to 9%. What is 9%? Let's put that into a perspective. Let's take a look. If you look at, okay, so again, this is the month-to-month percent change. So we actually dropped by about 9%. And if you look at that 8.7% at the very end, on the right-hand side, you'll see it's actually bigger than a lot of the time periods that we had going back to 1992. In fact, if you compare it to the last recessions, I mean, many of us remember the last recession in 2008, 2009. The month-to-month drop during the biggest month-to-month drop during that period of time was about 4 or 5% right here. So compare even to the last, recessions, what we named as Great Recessions, it dropped even more. The last time we actually had a month-to-month drop that big was going back to 1940s, around World War II time. That was really, really way back about 80 years ago. So you can see how extensive the damage or the blow to the economy is because of the coronavirus. And taking a look at it from a different perspective, retail sales affect economic growth, and this shows you a timeline, a short timeline, a month timeline on how the shutdown as well as the coronavirus impact or the fears for coronavirus might have affected our GDP. This shows a daily GDP loss and how much we have lost how much we have lost so far at the end of April. If you look at April 3rd or the first week of April, you can see about 28%, 28, 29% of the daily GDP is lost because of all the shutdown, because of all the stay at home. We're not really doing all those economic activities that we normally do. So about more than a quarter of our GDP is lost. That's why it's pretty significant to our economy when we have the stay-at-home order and shelter in place. Now, those are things that we need to do, however, because we need to make sure that we control the coronavirus, to make sure that, you know, we get it under control, and then hopefully that will go away and tame down, and then we can resume a little bit of normalcy, but we can't rush it. Now, if you look at, let's look at, you know, at the state level. At the state level, for the California, the daily loss of output is about 2.8 billion, which is about 32% of, you know, the daily that we normally rack up, about 8.8 million. So California is on the same pace or a little bit higher than the nation as a whole as it's come to loss of output. So, of course, with all those economic activities kind of slowing down, a lot of people actually have lost their jobs. A lot of companies, a lot of services, small businesses have to shut down, at least temporarily. And so you have seen some of the reports from the Department of Labor. In the last few weeks, we have a lot of job losses. We have seen a lot of people filing unemployment insurance claims. In fact, you know, the number that was reported yesterday was 5.2 million. The week before then was 6.3, and then we had a 6.6, and then the 3 weeks ago we had a 3.2 million. But prior to that, just to put things into perspective again, prior to that 3.2 million or so, the week before was 700,000, and the previous record before the current 6.8 million was in the last recession in 2008, 2009. At that time, look at the number. The record at that point was quite around 700,000 or so. So we're significantly higher than what we were at in 2008, 2009. In fact, if you look at, you know, how many people actually lost their job within a two-year period of time during the recessions in 2008, 2009, total number of people who lost their job was 37 million. And how many people have already filed claims? We have 22 already. So we have already passed half the number of what was achieved in 2008, 2009 within a two-year period. We did that in 4 weeks. So this is how significant it is. Now, I do believe, despite the fact that it is a significant number, it's a huge number, the disruption is so sudden. You know, we had a sudden halt in such a short period of time, and that's the reason why we have so many job losses in 4 weeks. Now, I think when things get better later on, when the pandemic started dying down, some of those jobs probably will be recovered, but some of those may not because of the economic conditions that we are in right now. I'll go over that in the next, you know, after in 20 minutes or so on the outlook. I'll talk a little bit more about that. But at the same time, in the financial market also have been seeing some stress. Many of you, a month ago, 2 months ago, might have seen, you know, the stock market, Dow Jones Index actually peaked at about 29,000 or so. Since then, we have been seeing some drop off. At one point, it actually dropped all the way down to close to 18,000, maybe 18,500 or so. That is about 35%, 36% decrease from the peak. After it bottomed, lately we have been seeing some rally. It has gone back up to about 24, 25. I think today it might have gone up a little bit. But still, we are down about 10, 15, 20% or so compared to the peak. And it's not just in US, it's around the world as well, in some of the other countries and all those. You know, this is really a global pandemic. You know, we have been seeing the financial markets react in many places in Japan and London and other places as well. So we are seeing, some significant decline. And even I think I don't have the numbers here. Even in China, even though they have sort of recovered, not completely recovered. I think as far as number of cases, they have dropped down, but then I think yesterday they might have some cases come back up. Even for China, when we look at the number of their economic growth, I think I saw a news, and don't quote me on it, I think I saw a news yesterday or this morning that the growth rate has gone down by something like 6% or so, as compared to what they used to before that, or the quarter before that, in the fourth quarter, I think it was growing close to 6%. So it is again a global economic retreat. Now, how does that? Now you have already seen, what it does to the economy, and how does that actually translate into our market sectors, in the housing market. Let's take a look. Some of you may have noticed that we released our March data yesterday, and some of you might have already used some of those numbers. The March data reflect, sales and price and activities in March. Now, keep in mind, in the first couple weeks, the housing market in California was still pretty active. In fact, first 2 months of the year, we were pretty strong. We were actually up by about 6 or 7% for those 2 months. Even in March, the first 2 weeks of March, I think we were up year over year compared to the previous year. So if you take a look at the sales, as far as sales are concerned, it actually declined for the first time. For the first time in 9 months, it actually dropped by 6.1% in March. Now, keep in mind, because as I mentioned earlier, the first 2 weeks it was actually pretty active, and then the second half of March has actually started slowing down. So the 6.1% that we're looking at right now, the drop in March, doesn't necessarily reflect the whole picture of how the coronavirus might have impacted the housing market. What about price? If you look at price actually shows that it actually continued to remain somewhat strong. If you look at the year-over-year percent, the year-over-year percentage actually shows an 8.3%. This is pretty consistent with what we have seen in the past. The 8.3% that we saw, the 8.3% is consistent with what we saw in January and February. Both of those months show somewhere around 7 to 8% increase. I can't remember the exact percent increase in the very first month of the year, but it did grow. It did continue to grow on a year-over-year basis. Currently in March, if you just look at March number, it is at 612,440. That's still below the peak, but it's actually, the peak was, I think, in August, and it was 617. So we have gone through. We're not that close to the peak yet, and we're closing in, but it's not there. And I do believe that in April and May we probably will have some retreat in price in the in the next couple months or so, simply because of the concern about the market conditions, concern about the economic conditions, and things like that. I know we're seeing a little bit of additional graphics on our slide. I don't know if I can actually get rid of those, but bear with me. Hopefully those will go away. I think I'll try my best to go through the slide without being distracted by those additional lines on the graphs. And again, apologize for those additional lines. So I think the way to look at the current market conditions is to look at more than just the monthly that we put out. The monthly obviously is a snapshot of the market on a monthly basis, but I think we need to hone in a little bit. We need to look at the weekly stuff. If you look at the weekly, here's some of the weekly statistics that we are seeing on our MLS statistics. It's getting, our graphics is getting a little skewed with some of those lines. But now let's focus on the Southern California for now. If you look at Southern California, take a look at right in the middle right here. 335 is the midweek of March and March 15 to 21st. That actually is the peak in the month of March. But you take a look at what happened after that. It actually started dropping. From 335 to 311 to 279. Typically, that's not a typically the month of March is the kickoff of the home buying season, and unfortunately, because of the coronavirus impact, we started seeing some decline. Normally, we should continue to see increase in the average daily closed sales, but because of the shutdown, because of the shelter in place, we're not seeing that. Let's look at the improvement. Let's look at the individual percent decline. We're seeing in Southern California a drop of 7% and a 10.2% in the week-to-week comparison. Now, if we look at LA individual county, you can see that similar trend seemed to reflect what happened in Southern California as well. LA County actually peaked in the second week, and after we had those stay-at-home orders, it started slowing down. And in fact, it has gone down to 69 in the first week of March. For the last week of March, the first week of April. That means we have gone down to maybe by 20, 25% or 30% or so. Keep in mind now, these are closed sales. I want to go back and say closed sales are typically negotiated. Closed sales in March were negotiated at the end of January and maybe beginning of February. So those are closed sales. Those they're already in system. The reason why we're seeing some slowdown or slow growth or drop off in sales of closed sales are typically because the coronavirus is really impacting not people's interest for closed sales. Those closed sales transactions are basically delay of closing because of the shutdown in the industry, and also the shutdown or slowdown in the economy that affects the closing. What we should look at if we want to take a snapshot of what's going on with the current housing market conditions, what we should really look at is the pending. First of all, thank you for clearing the graphics for me. Thank you. Now, what we should look at is the pending. Look at pending sales. Pending shows buyers' interest. When we look at pending sales, it does show that it remains very, very weak. Look at SoCal. I want to focus on SoCal. It peaked in the first week of March, and then it started slowing down. It shows, that things, even the second week, it was still okay. But then starting in the third week, when we had the stay-at-home order, it started really slowing all the way to half of, take a look at the last week that we have. It's actually only half of what we had 4 weeks ago at the beginning of March. So we are seeing some buyers' interest being dropped off, partly because there are a lot of different reasons. I'll go over some of those reasons in a minute. Take a look at the drop-off. It's drop-off for Southern California, drop off double digits for the last 3 weeks or so. And as far as LA, look at what happened. Again, dropped more than 50% on a daily pending sales, dropped from 102 to 48. So it could be a lot of different reasons. And if you look at individual counties, all of them are showing actually pretty steep decline. Except for San Bernardino and Ventura, which dropped a single digit. Now, there are a lot of different reasons for why pending sales drop. Another indicators for the pending sales or buyer's interest is mortgage applications. I have been showing you weekly numbers, but here's the year-over-year number, and you can see for the U.S., 35% of mortgage applications, which is another indicator of where the market is as far as demand is concerned, dropped 35% for the U.S., but for California it dropped even more, dropped by about 52%. So a lot of sales have not gone through, or people were actually not as refraining from the economic activities as well as the housing activities. And you can see from here, this is a slide that shows you number of showing activities. Showing activities actually has been trending at around the same as last year until the second week of March, and then it started drowning. So it is pending sales have been dropping. People's interests have been curtailed in the last few weeks, obviously because of concern about the coronavirus impact, not only on the health front, but also on the economic conditions. We ask, here's a survey that we sent out, and this is the first slide of the survey that we sent out. We ask our members, how many of them how many of them actually had open houses canceled? And even a few weeks ago, we had 61% of the people who had said, their sellers cancel their open houses. 66% today said, or the latest statistics show that they had open houses cancel. That's one of the reasons why we're not seeing pending sales. We're seeing some decline in pending sales because we don't have any showing activities. Also, people are holding back. I said, people are concerned about the economic conditions, about the market conditions. People are concerned, whether, the market is going to slow down, but many buyers actually concerned about their own financial well-being. You saw the numbers that I show. About 22 million people actually lost their job in the last few weeks. That's a lot of people. If you put that into perspective, I know a lot of people look at it from the unemployment rate figures. Now, our unemployment number was before the coronavirus impact was below 4%. But if you look at it this way, the 22 million people lost jobs, and the total labor force, the U.S. labor force, it is right around 165 million. So that is essentially about 13, 14% of unemployment rate. So compared to 4%, that's a significant increase in such a short period of time. And that's why people are concerned. People don't know, whether they'll be able to afford to buy a home now. So it's 90%, that's why 90% of our members said their clients actually pull back on buying for now. Some even withdrew from their offer. I've heard people actually decided to let go their deposits because they're concerned about what's going to happen to the jobs, to the conditions, and to the market. Now, another quarter, 28% to be exact, members actually said their transactions actually fell out of escrow, and the reason why they fell out of escrow is because of buyers backing out. Buyers, again, are not so sure about their financial conditions anymore. Some are concerned about being laid off, and some actually could be because of what happened to the financial market, to the stock market. They might pull out because of that reason. So that's the demand side. What about the supply side? We always talk about the market. When we talk about the market, we always talk about the supply and demand. And looking at the supply and demand side, we are actually if you look at the unsold inventory index, many of you are familiar with this number. The unsold inventory index actually slipped from 2.7 months to from 3.6 months to 2.7 months in the latest month. Now, it's not abnormal to see a decline from February to March, and we have been the inventory has been tightening actually on a year-over-year basis, but dropping from 3.6 to 2.7, that's actually pretty huge. Part of it, of course, is because of the last 2 weeks of March, when people actually stop putting listings on the market. You take a look at the slide, you can see we ask consumers. This is a survey to consumers. We ask them whether they think it's a good time to buy or a good time to sell. On the left-hand side, you see a slide that shows a graph that shows good time to buy. Even in March, we have received responses from people saying that it's okay. Now it's not a bad time to buy. It's consistent with last few months. But if you take a look at the good time to sell, that number dropped dramatically. It dropped from 58, 59 to 26. It dropped more significantly. It is also dropped from last year. Last year was 48%. It's 26% now. Sellers are concerned, and many of them, 80% of our members said sellers actually hold back as well. 81% of them actually said they hold back. That's a significant increase compared to 4 weeks ago when we only had 45% said they held back. And they also removed their listings from the market. Again, at the beginning of March, we only had 13% remove their listings off the market. Now 54%, half of them. So that's the reason why we're seeing fewer new listings on the market. When we look at our MLS number, when I look at the transactional numbers, we can see that it has dropped off precipitously. And the new number of new listings average daily at the beginning of March was 513. Again, this is a home buying season. This is we're going into the home buying season already in our home buying season. That's the time when a lot of sellers put their new listings on the online, and it has dropped off quite significantly. But here's the silver lining. It dropped off, but it looks like, now I don't have more recent data, but it looks like it is kind of leveling off now. For Bay Area, for SoCal, for Central Coast, and for Central Valley, it looks like we might have found a bottom. But we did drop quite significantly for the first 3 weeks or so by double digit before finding a bottom. Now, whether that is really the bottom, it's really hard to say. Again, we have to look at additional weeks of data to find out, to see if we're really leveling off. But even leveling off means here we're at a very, very low level, very low supply level. For LA County, it looks like individual counties also are showing that it's kind of leveling off a little bit. But we're half of what we had, in 4 weeks ago. I do believe that, when things got calmer and when people learn more about virtual tours and things like that, that number probably will start slowly creeping back up. But I don't think it will be back to the level that we normally can see until everything get actually sorted out, until the coronavirus pandemic kind of really slowed down and died down a little bit. And that could take months. Now here's the week-to-week percent change in new listings. As I mentioned, we have been seeing week after weeks of drop in new listings, but the latest week, except for San Diego and Ventura, we're seeing a little bit of an uptick. So now you have seen the supply side and the demand side of the housing market. You know that the situation is very challenging right now. We are with pending sales actually slowing down significantly. We're looking at April sales and May sales and maybe even the June sales at a very significantly below what we were last year. So how is this going to pan out? It really depends on how long the coronavirus the pandemic is going to be. But if you take a look at some of the comments, some of the forecasts by economists, many of them agree that we're either in a recession or we're going into one. Their opinions varies. But if you look at every single one, this is the GDP economic growth rate. If you look at individual forecaster, Bank of America, Goldman Sachs, JP Morgan, many of them actually believe that we are already in a recession. UCLA, at the I think they still believe that we're, in the first quarter that we actually had a gain, but second quarter, everyone pretty much believe that we are down in the second quarter. Some believe that we'll be down by 50%, the Federal Reserve of St. Louis. But many people believe that we're at least 30% down. Goldman Sachs, 34%, UCLA, 30% or so. Some believe that the third quarter will still continue to suffer, and then we'll be back in the fourth quarter. Now, keep in mind the coronavirus impact, as I mentioned, it is very strong, it is very fast, and it's very disruptive. But we do believe that this is more a supply, it is more a shock that actually will eventually recover. But how fast? It really depends on the. It's not a question of um, that an economist may be able to answer. It may be more a questions from a scientific perspective. We have to look at the projection of the coronavirus pandemic. Now, this is one projection that was done in March, end of March. If you just based on this projection, it looks like the peak is going to be near the end of April, beginning of May, but we have been practicing social distancing. By the way, this is California projection. We have been practicing social distancing. So this number, which shows the number of people who has been hospitalized or the resources that we use, those. So this line, just to give you some idea, this is a line where we the number of hospital beds that we need, projected number of hospital beds that we need. So 2 weeks after the first projection, in April 12th, earlier this week, we had another projection. It looks like social distancing is working. The stay-at-home order and the stay-in-place order seems to be working, and we actually had that number lower. We show you the number again. It was much higher as far as the number of hospital beds that needs. Has gone down from somewhere around 12,000 or so in California to somewhere around 5,000 or so. If we continue to practice, the social distancing and keep the stay-at-home order in place, maybe we can get through this a little faster. And maybe that's the reason why Governor Newsom suggested that we should have or set the date of the order to be extended to May 15th. Look at the projection here. It looks like that number of new cases will eventually slow down in the middle of May. Now, that doesn't necessarily mean that everything will be back to normal. I mean, I think it would take some time for us to actually go back to quote unquote normal. I think we need to get used to, the social distancing for a little bit. And it really works because if you look at what happened in Hong Kong and in Singapore, they experienced similar pandemic, but both Hong Kong and Singapore were able to use aggressive measure at the beginning, and so they were able to keep it down. And then they received a second wave. Hong Kong and Singapore received a second wave, sudden increase of cases. Now they took a different approach. For Hong Kong, it's actually they became more aggressive and make sure that people continue to practice social distancing and be a little bit more aggressive. So they were able to keep the number of new cases down. Take a look at this white line here. But for Singapore, I think they were a little bit more relaxed at the beginning, and so the number of cases actually shot up. At the beginning of April, I think recently they started tightening it up a little bit, and so they were able to kind of calm things down a little bit. So it does show, based on those two countries' different measures, it does show that social distancing actually works. Another graph to show you that it is hard. We can't just rush to get back to normal. Some people did a model, and if we were to just have social distancing for 14 days, if we actually open up sooner, then the number of infections will be 128 million, as compared to if we actually have social distancing for 2 months or so, we keep the number down significantly. So how long it is going to be, again, it really depends on the pandemic situation. If we do have most cases actually slow down and die down, then we can take a look at some of the case studies that were done in the past. This shows you 3 cases. The slide shows you 3 cases. The first one is the SARS outbreak, some of you are familiar with. The Fukushima disaster that happened in Japan in 2011, and the MERS outbreak in South Korea. Those 3 charts show you the retail sales, how that actually react to the outbreaks. You can see in the SARS outbreak here, the outbreak spreads actually took about 2 months or so from the start to bringing the retail sales to the bottom. It took about 2 months. and then it started recovering. And the whole process, if you look at all three cases, the whole process took about either 5 or 6 months or so. In this case, in the MERS outbreak, took maybe a little longer. Um, so 5 or 6 months. If we start our, if our outbreak started in the beginning of March, let's say, we're looking at July, August, for things to calm down a little bit. Now, keep in mind the shock is really, really significant this time. I think more significant than all those cases. So it may take a little longer. But if we started controlling and making sure that the coronavirus is under control, I think we can get back to normal a little faster. But normal is, of course, relative. I think it will take some time for us to get back to the normal that we saw at the beginning of this year. It may take more than 5 or 6 months, but at least we can have some sort of activities. Now, I want to show you this chart also that the recessions is a little different compared to what we saw in the past. And compared to 2008, 2009, the recession is a little different. The recessions might be more similar to a shock because of due to a natural disaster. This is a chart that shows you the jobless claims in Louisiana when Katrina hit in 2005 and 2006. The jobless losses, actually, and unemployment insurance claims shot up significantly. Take a look at right here. Shot up significantly, but eventually it dies down. So I think we might be seeing something similar. We will see significant shock in the last few weeks for unemployment claims. Hopefully, when things calm down a little bit, when we have a little bit more activities, economic activities, things will actually be able to recover a little faster. Now, it is probably going to take a little longer than what we originally anticipated or what many economists originally anticipated, but I think it will be in terms of the severeness in terms of how long the recessionary period is going to last, it's going to be less than what we saw in 2008 and 2009. So now the government also is doing their part to expedite the recovery process. You probably have heard of the fiscal stimulus, which I'll show in a minute. The monetary stimulus is the other part that the Federal Reserve actually has been implementing to keep the economy going. The Federal Reserve, you probably know that they have already cut Fed funds rate down to 0 to 0.25% a few weeks ago. They lowered the discount window and they expanded the repo operations and also restarted quantitative easing. They also created many programs, many new programs. And the reason for the new programs is to allow money to actually flow into the system to make sure that lending is lending's being done a little bit smoothly. But of course, it's hard to predict, and that's the reason why we actually had some increase in a significant increase in interest rates for like a day or 2 or 3 days or so, and then it came back down, and it came back up. So the Federal Reserve wanted to make sure that we have money in the system, and they're willing to continue to support the financial system. At the same time, the federal government have been doing some stuff. They have the Coronavirus Aid, Relief, and Economic Security Act, the C.A.R Act. And there are quite a few provisions to the C.A.R Act. I only pointed out a few here that might be relevant to us, to realtors. And some of you probably have already received the direct payment of realtors, to direct payment of direct rebate checks. Some of you have already seen that rebate checks in your checking account or your saving account. I think many got deposited directly to your account yesterday or the day before. And the idea is to stimulate the economy. For people who have income below $75,000, they receive a rebate check of $1,200. And for married couple, the threshold is $150,000, and then additional money for kids. So that's a rebate check that hopefully can help ease the pain, the economic pain that we are enduring during this period of time. The other programs include the Small Business Administration loan, the forgivable SBA loans. Unfortunately, I think I have to say the SBA loans actually ran out of money, and they're currently, many of you might have submitted applications and might got rejected or denied because their funding actually is, they exhausted their funding. But the Congress is actually trying to get more money, for the SBA loans. Hopefully, they'll come up with more so that will allow a lot of the SBA or small businesses to continue to survive by getting some of those loans. And then, of course, I think many of you are interested in the PUA, the Pandemic Unemployment Assistance. Now, this applies to independent contractors, which includes realtors, and which normally realtors are not able to get unemployment insurance. But with the PUA, one can actually obtain unemployment assistance for up to 39 weeks. There are good news and bad news. The federal government approved it, but unfortunately, the state, the EDD, have not been able to accept applications because they have been, putting together the form. I think they will have the form maybe in about a week, 2 weeks from now. I don't have the update, but C.A.R. has been updating and putting things on our website, so definitely go check our C.A.R. website to get more information on the PUA. Now, to understand, so that's the economic, how long, what I think the economy is going to do, how long it's going to take for it to recover, and some of the programs that the government actually has been doing to try to push the economy in the right directions. But how does that affect the housing market? Again, it's hard to predict. There are a lot of variables, a lot of uncertainties about what's going on, and the most important thing is we don't necessarily control the time. It's the pandemic, the coronavirus, that controls the time. So it's a little hard to figure out. But we can take a look at the previous recessions and how it affects the housing market. Now, those shaded gray area, those are the recessions period. You can see this is a home sales, and what happens to home sales during recessions period is in the very first year, right here, and every single year, every single recessions, the very first year, we observe a drop in sales. So I will not be surprised this year we are going to see a sales drop, especially since I mentioned second quarter we probably will see a significant decline. Third quarter we probably will see a decline as well. If you look at the pending sales based on our monthly statistics, pending sales suggest that in March it has dropped down by 25% already. So I wouldn't be surprised if in April we started seeing a pretty significant steep drop in excuse me, pending sales. So expect April sales to actually go down at least double digit, meaning 20-25% or so. And then what about price? And also May, for let's go back a little bit. May, obviously we don't have pending sales number for May yet, but pending sales for April yet, but I believe May actually could drop a little bit more. Now what about price? Price surprisingly has been actually holding up quite well. You saw the numbers that I released earlier. For March, it actually has gone up by 8%. So the price growth actually has been mostly positive as far as the recessions are concerned, except for the last one. If you look at the previous recessions, again, look at the gray area, all home price, and the green line is the year-over-year percent change. In the last 4 out of 5 recessions in the last 50 years, we have been seeing some price growth in recessions, except for maybe this one, a slight price growth, maybe just a small dip. But 4 out of 5, we're seeing pretty positive sign on price, except for the last one. This last one, very last one, is again, the recessions is primarily because of a housing market collapse. So it's not a surprise. We had some overpricing in California, and I've shown some slides before, but I don't have it here, that a lot of the houses that were foreclosed last recession, it was because of people over leveraging. We did have a lot of people putting 0 down payment So they were foreclosed. Their properties were foreclosed. This time around, the number of people who actually put down 0% down payment in the last few years have been actually very low, a few percentage, like 3 or 4% as compared to back then and 10, 12 years ago, it was 20, 30% who put 0% down payment. So that's a little different this time. And I do believe that the number of home prices, actually, you will see a slight dip in home prices in the immediate month, like in April or so. We already have seen this is the list price growth. List price usually is a leading indicator to closed sales price. We have already seen a sharp deceleration. Now, still an increase in price, but a sharp deceleration for list price. I do believe that we will see very, very slow price growth if there is any in April, and maybe starting to see some price drop in May also. I looked at the pending sales price, which I don't have a slide here. It does show that there is a small dip in price. And I think it is probably going to show more dip in price in May, maybe in June. But I do believe that we are going to see a better bounce back in the housing market as compared to other industries. Part of the reason is we do have a low rates environment. Rates remain at very low level and will probably continue to remain at a very low level in 2021, in the fourth quarter and also 2021, so that the economy, the Federal Reserve will try to keep the number down so that they will continue to, the economy will, as well as the housing market will continue to grow. So I expect, the interest rates to stay low at around, between 3.1 to 3.4 or so. It's continued to stay at a low level now. So if it continues to stay at a low level, I think housing market will bounce back. And I believe, home prices, as I mentioned, it will drop. It probably will drop, but how much? It's hard to say. Now, I have the concluding remarks here, but I'm going to tell you my take on what I believe is going to happen to, the sales and price for this year. Next year, we probably won't have a number until a little bit later this year. But I don't have a slide. I normally have a slide at the very end on forecast, but I don't have that slide because there's still a lot of uncertainties out there. But I can tell you that as far as sales are concerned in 2020, second quarter is going to drop. Third quarter, we're going to have a decline in sales. We might even have a decline in sales in the fourth quarter. So when you take the whole year, the year as a whole, then we probably will see a low double-digit decline in sales, meaning somewhere between 10 to 15%. I don't have the exact percentage, but it probably will be somewhere around 10 to 15% in terms of sales. But what about price? Price is the tricky part. I do believe that we are going to see, for the year as a whole, a slowdown in price, probably in the low single digit. So we're looking at somewhere around 5 or 6% or so. Again, the exact number, it's hard to pinpoint or pin down, but that's the outlook. Now, here are some key highlights. I know we've talked about for an hour already. So here are some key highlights. The pandemic is really, what determines the how long the recession is going to be and how long it's going to take for the market to recover. It's hard. There's no use of rushing it because we really need to have a pullback to make sure everything's calmed down first before coming back. The market is going to face some challenges in the near term, meaning in the next couple quarters or so. There are a lot of uncertainty, so it's a little too soon to tell whether there will be any permanent behavioral changes. When I say behavioral changes, I mean because everyone is actually staying at home right now. We may have more companies doing remote work, working remotely. So it may change the home purchase distribution. Many people may want to buy at cheaper places, rather than staying close to their work. So who knows what's going to happen? We'll have to find out. Again, it's too soon to tell. And as I mentioned earlier, housing could be a bright spot after crisis because we do have a favorable mortgage environment, but we also have, if the recession is short, we could bounce back and things will get back to normal. Plus, remember, we still have a very tight inventory environment. We still have a very tight supply environment. Compared to last time, we actually overbuilt in 2008, 2009, or prior to that, we overbuilt. This time around, we have a supply shortage. So I think we are going to do better than other industries in 2021 when we getting back to the recovery mode. So with that said, let me give you some resources that are available to member at C.A.R. I mentioned that you can get a lot of information from our website, the coronavirus microsite at C.A.R., the very top one, car.org coronavirus. We also have the COVID relief hotline. This is a hotline about if you have questions regarding some of the financial assistance program offered by the C.A.R.E.S. Act. You can call this hotline to find out more information. If you have questions about that, it will give you some good insights. We also have a weekly newsletter that we send out. And so take a look at it. There are other hotline numbers on there. If you have other legal questions, transaction rescue questions, you can definitely take a look at it. Lastly, I want to show you my my email address. I will be posting this presentation on the C.A.R. website in the speeches and presentation folder, just like what we normally do. And if you have any questions, feel free to send me an email as well. So this is the end of the presentation. I know we probably have some questions. I'll turn it back over to Albert.
Thank you, Oscar. Let me see if Albert's still on here. Oh, maybe he logged out. Let me see if Pauline's on here. Okay, so I know a lot of people are asking about the slides. Yes, we will email everybody the slides, and this session was recorded. It'll be uploaded on our website as well. Okay?
That's great. Any questions that they need to ask? Or if we don't have time, I know we might be running out of time. And if some of those questions were not addressed in my presentation, feel free to send me an email or forward those questions to me. I can answer those questions via email as well. I do see some questions. Do you want me to answer some of those questions in the group chat here?
Sure, go ahead.
So I think I saw a few questions. One regarding whether it's a good time to invest in income properties. The question about whether it is the right time to buy or not, it really depends on individuals' financial situations. Of course, some people who has the financial capability of doing so might be a good time to buy. But at the same time, if you're looking for, as I mentioned, if you're looking for properties prices to actually go down and then try to swoop in and get the best prices, as I mentioned, we are going to see some dip in home prices, but it may not actually go down by that much. So I think, but I also mentioned that eventually it will come back. So it is a good time to buy in the sense that people have the financial capability to do so, and they actually want to lock in with the low rates, and they see something that they like. Sure. It's not going to be, as I mentioned, it's not going to drop by 10-15% in terms of price. So hopefully that answers your questions. Now, I also have other questions. I saw another questions about open houses. I think we definitely need to follow the strict guideline about open houses. There's a lot of things mentioned on our C.A.R. website, on the microsite, that gives you guidance on what to do when it comes to open houses. I think in general, open houses in general now are actually people. We would suggest C.A.R. suggests not doing open houses except if you have a vacant properties. If the property is already vacant and you follow a strict guideline, and you can see the best practices that we laid out on the C.A.R. website, then some open houses may be okay. But yeah, most of the open houses should not be done if it is the typical open houses. But again, take a look at our best practice guidelines on the C.A.R. website. I think I talk about most of the stuff. I think someone asked me about rent prices in the group chat. As far as rent is controlled, I think we probably will see some slowdown in price in rent prices. Now that might be short term, but also at the same time we also have a lot of discussions about rents. Renters may not be able to pay because of the financial conditions right now. So we might be actually seeing some, if we have been seeing, depending on which areas we're in, some areas we continue to see average rent growing before the pandemic, before the coronavirus. But we probably will be seeing those prices go down or slow down a little bit. But because of the financial and the number of job losses that we have seen, then most likely because of the economic conditions, the rent is going to be rent growth for the next few months are probably going to slow down a little bit, even dip slightly, but it's not going to dip that much for now. Let me see what else. I think I answered most questions already. I strongly suggest everyone to take a look at the best practice guideline on the C.A.R website. It gives you all the information, all the best practice you should adhere to as far as being a realtor, real estate agent. So definitely take a look at it to get a sense of what we should be doing. One more questions regarding foreclosures and REOs. I think someone asked me about the REOs or foreclosure before. Are we seeing a significant increase of foreclosure like what we saw in 2008, 2009? My answer is probably not. We are going to see some increase in foreclosures. There's no doubt about it, increase in REOs. But we're not going to see what we saw in 2008 and 2009 because of the reason that I laid out earlier. We had fewer people, actually much less people putting down a 0% down payment, and they were not as over leveraged as before. So we will see some increase in foreclosure, maybe a few percentage more. And maybe now you will see some people applying for forbearance, which means they may actually not pay mortgage payment for a few months because of the financial conditions. But as far as foreclosure is concerned, I do not see that we are seeing an increase in foreclosures that much. We are going to see increase in foreclosure, but not as much as what we saw in 08 and 09. So hopefully I answered most of your questions. Again, if you have any questions that I did not address, send me an email at oscarw@car.org. It's oscarw@car.org.
Oscar, thank you very much for your informative presentation. Earlier, I was trying to unmute myself, but couldn't. So thank you
No
very
worries.
much